All right, let's unpack this, huh? We're doing a deep dive today into textiles. Specifically, Pearl Global Industries' second quarter results for FY25.
And you've sent over quite a bit of material.
Yeah.
We have their official company announcement.
Yep.
We've got a detailed investor presentation and even some really interesting questions.
This is going to be a good one.
But what I find fascinating is we kind of get to see this story from multiple angles here. It's
Yeah.
not just about the numbers,
Right.
but we get to kind of understand the strategy behind them as well.
Exactly. Let's jump right in.
Okay.
The big news is Pearl Global celebrating a record-breaking performance.
Oh, wow.
For the first half of FY25, both Q2 and H1 saw their highest ever revenues.
Yeah, that's right.
Ever.
We're talking 1,201.9 crore for Q2.
Wow.
And a remarkable euro 2,254.7 crore for the first half of the fiscal year.
Okay.
That translates to year-over-year growth of 25.1% for Q2 and 21.6% for H1.
That is impressive. But what's driving this success? Is it simply a case of a rising tide kind of lifting all boats? Or is Pearl Global doing something special?
I think it's definitely more than just market trends.
Okay.
A key factor here is their diversified approach.
Okay.
They've seen strong sales growth in Bangladesh, India, and Vietnam.
Interesting.
And this tells me that they're not putting all their eggs in one basket.
Right.
They're strategically tapping into multiple growth markets.
And speaking of Bangladesh, that brings us to a really interesting point.
Okay.
They achieved these record numbers despite some serious disruptions there in July.
Absolutely. And if you look at their investor presentation,
Okay.
they emphasize 0 delays in deliveries.
Wow.
Despite the challenges,
Yeah.
this speaks volumes about their operational resilience and their commitment to their customers.
So I'm curious, what kind of disruptions are we talking about, and how did they manage to navigate them so effectively?
So unfortunately, the materials that we have don't go into specifics about the nature of these disruptions.
Okay.
However, their ability to maintain record shipments in August and September immediately following these issues suggests they have a robust supply chain and a very flexible approach to operations.
That's a great point.
Yeah.
Being able to adapt quickly to unexpected challenges is crucial,
Yeah,
especially in today's dynamic business environment.
absolutely.
And there's another piece of good news coming out of Bangladesh.
Okay.
Their subsidiary there, Norpnit Industries Ltd, contributed significantly to the holding company's bottom line.
They did through dividends.
Okay.
13.5 crore in Q2
Wow.
and 8.74 crore in Q1.
Okay.
So this steady flow of income from a key subsidiary definitely strengthens Pearl Global's financial position.
Absolutely.
Yeah.
And speaking of dividends,
Okay.
Pearl Global declared an interim dividend of €5 per share
Wow.
for the first half of fiscal year 25,
Okay.
a 100% payout, which is pretty significant.
It is, and it's not just a one-off event. They have a formal dividend policy
Oh, really?
committing to paying out at least 20% of their consolidated profit after tax every year.
Wow.
So that kind of consistency can be really attractive to investors
Right.
who are looking for a reliable return.
For sure.
It shows confidence in their future performance.
Yeah, but let's not forget about profitability.
Okay.
How are their margins looking amidst all this growth and expansion?
That's where things get even more interesting.
Okay.
Despite some headwinds, Pearl Global has managed to maintain a healthy profit margin.
Okay, let's break that down.
All right.
What do the numbers tell us?
So both the first half of fiscal year 25 and Q2 saw adjusted EBITDA margins hold steady at 8.8%.
Okay.
For those who might not be familiar, adjusted EBITDA,
Mm-hmm.
or earnings before interest, taxes, depreciation, and amortization,
Right.
is a key metric used to evaluate a company's operating performance.
So a steady 8.8% margin means they're keeping costs under control even as they grow.
Exactly.
That's a good sign.
Yeah. And to put it in perspective, for H1 FY25, their adjusted EBITDA increased 21.6% year over year to 199.2 crore.
Okay.
While Q2 saw a similar jump of 24.4%
Wow.
to 98.8 crore.
That is impressive.
This consistent profitability, despite the challenges they faced, is pretty impressive.
It really highlights their ability to manage costs efficiently while continuing to expand their operations.
Yeah.
But I'm sure there's some challenges they're facing on the profitability front.
Oh, for sure.
Right.
Yeah.
I mean, after all, they're making significant investments in new facilities.
You're right. And their investor presentation acknowledges that their new factories in Chennai and Gurgaon, which are still ramping up, have put some pressure on their margins in the short term.
I see.
But they're confident these investments will lead to greater production capacity and market reach in the long run.
It's a classic case of short-term costs for long-term gains.
Exactly.
And to fund these growth initiatives, they raised a substantial amount of capital, didn't they?
Yes, they did. Back in July 2024, they completed a qualified institutions placement of equity shares, raising a total of 149.5 crore. For context, a qualified institutions placement is essentially a way for listed companies to raise capital by issuing shares to qualified institutional buyers.
I see.
So this significant capital injection is a clear indication of their commitment to expanding their footprint and capabilities.
It seems like they're playing the long game.
Yeah.
They're not afraid to make bold moves, but operating in a global market like they do.
Right.
I imagine there are some potential headwinds they're facing as well.
Absolutely. And the source material highlights a few key risks, including the rising cost of raw material.
Okay, that makes sense.
This is something that could potentially squeeze their margins if they can't manage it effectively.
And what about the overall global economic outlook?
Yeah.
There's been a lot of talk about a potential slowdown. Could that impact Pearl Global's performance?
Definitely something to keep an eye on.
Yeah.
A global economic slowdown could lead to reduced demand for textiles, which would impact their sales.
So while their current performance is undeniably strong, there are some external factors that could pose challenges in the future.
Yeah.
It'll be interesting to see how they navigate these potential headwinds.
Absolutely.
But before we get into that,
Okay.
let's take a closer look at their consolidated financial performance.
Great idea.
Analyzing their consolidated figures will give us a clearer picture of their overall financial health and the interplay between their different business segments.
Yeah, for sure.
All right, so we've established that Pearl Global is performing exceptionally well overall.
Yeah.
But let's dive deeper into their consolidated financial performance.
Okay.
And see what's happening under the hood.
Sounds good.
A good place to start, I think, is with their revenue breakdown by geographical segment. This gives us a better understanding of where their growth is coming from and how their global strategy is playing out.
Yeah, for sure.
Okay, so looking at their consolidated profit and loss statement for the first half of FY25.
Okay.
Which regions are contributing the most to their revenue?
So Hong Kong takes the lead, contributing 51.27% of their total revenue.
Wow.
This isn't surprising, given that Hong Kong is a major hub for textile trading. And Pearl Global has a long-standing presence there.
Okay, that makes sense.
Yeah.
So where do the other regions stand?
Bangladesh follows Hong Kong with a 19.09% share of revenue. And then comes India at 14.85%.
Okay.
It's worth noting that both these regions have been instrumental in driving Pearl Global's recent growth spurt.
And we can't forget about Vietnam, which is becoming an increasingly important player in the textile industry.
Absolutely.
That's their contribution.
Vietnam accounts for 10.76% of their total revenue.
So this clearly demonstrates their commitment to diversifying their operations and tapping into new growth markets. It's a smart strategy. Having a balanced portfolio of revenue sources helps mitigate risks.
Absolutely.
And provides more stability in the face of market fluctuations.
For sure.
But revenue is only part of the story.
Okay.
Let's talk about profitability. How did they manage their costs during this period of rapid growth?
So looking at their consolidated adjusted EBITDA margin, which, as we discussed earlier, gives us a good picture of their operational efficiency. It remains stable at a healthy 8.8% for both Q2 and H1 FY25. This suggests they've been able to maintain a tight grip on their costs, even as they scale up their operations.
That's reassuring.
Yeah.
Especially considering that they're investing heavily in new facilities, which typically comes with additional costs.
You're absolutely right. And those investments are reflected in their increased depreciation and amortization expenses. Think of it like this. When a company invests in new equipment or buildings, those assets lose value over time due to wear and tear. Depreciation and amortization account for this gradual decrease in value.
So how much has this impacted their bottom line?
For the first half of FY25, their depreciation and amortization expenses increased to 35.2 crore.
Okay.
Compared to 29.1 crore in the previous year.
Okay.
This is a direct result of their expansion efforts.
Okay.
Particularly new factories in Chennai and Gurgaon.
It's a trade-off they're willing to make, though.
Right.
They're betting that these new facilities will eventually pay for themselves.
Yeah.
By increasing production capacity and opening up new market opportunities.
Exactly.
Now, another detail worth noting is their finance costs. They stand at 2.1% of sales.
Okay.
Which indicates they're utilizing a mix of debt and equity to fund their growth.
Yeah, it's a pretty common strategy for companies looking to expand.
But are they taking on too much debt?
So their investor presentation suggests otherwise.
Okay.
Their net debt to EBITDA ratio, which measures their ability to pay off debt using their operating income, stands at a healthy 0.28 for the first half of FY25.
Right.
This means they're managing their debt levels effectively and are not over-leveraged.
That's a good sign.
Yeah.
It means they have a solid financial foundation and are not putting themselves at unnecessary risk.
Now, let's take a look at their consolidated balance sheet, which gives us a snapshot of their assets and liabilities at a particular point in time. As of September 2024, their total assets grew to 2,342.5 crore. This increase is primarily due to their investments in property, plant, and equipment, right-of-use assets, and inventories.
Hold on. What are right-of-use assets?
Yeah.
It's not a term you hear every day.
You're right. It's a relatively new accounting concept. Essentially, right-of-use assets represent a company's right to use a leased asset, like a building or machinery, for a specific period of time.
So it reflects their commitment to using lease financing strategically as part of their expansion strategy.
Exactly.
That makes sense. And how about their liabilities? How have those changed?
Their equity attributable to equity holders, which represents the ownership interest of shareholders in the company, increased substantially to 1,074.4 crore from 817.5 crore in March 2024. This indicates that their financial position is strengthening and they're building a solid equity base.
This is all very encouraging. It seems like they're managing their finances responsibly while pursuing an ambitious growth strategy.
Absolutely.
But let's not forget about cash flow, which is often considered the lifeblood of any business. How did Pearl Global perform in this critical area?
Their consolidated cash flow statement provides valuable insights into how they're managing their cash resources. Their net cash flow from operating activities, which is the cash generated from their core business operations, stood at 53.8 crore for the first half of FY25.
That seems like a significant drop from the previous year's figure of 315.7 crore. Is that a cause for concern?
Not necessarily. Cash flows can fluctuate due to various factors, including timing differences in payments and receipts, changes in working capital, and investments in new projects. It's important to look at the overall context.
You're right. So what's the context here?
If we look at their investing activities, we see a significant outflow of 214.2 crore during the first half of FY25. Primarily due to their investments in property, plant, and equipment. This aligns with what we've been discussing. They're putting their money where their mouth is and investing heavily in expansion. And what about their financing activities? How are they funding these investments? They've had a net cash inflow of 141.9 crore from financing activities, largely driven by the issuance of share capital through their qualified institutions placement, which we discussed earlier.
That was a smart move.
It
allowed them to raise capital without significantly increasing their debt burden.
Exactly.
It seems like they're striking a good balance between different funding sources.
Absolutely.
Their consolidated cash flow statement paints a picture of a company that's actively investing in its future while maintaining a healthy financial position.
So we've covered their consolidated financials, and it's clear that they're on a strong growth trajectory. But what about their standalone performance? I'm curious to see how their Indian operations are contributing to the overall picture.
That's an excellent point. Analyzing their standalone financials will give us a more granular view of their operations within India, which is a key market for them.
For sure.
Okay, so let's zero in now on Pearl Global's standalone performance in India.
Right.
I think this will give us a clearer understanding of how things are going in that specific market.
Sounds good.
So when we look at their standalone profit and loss statement for the first half of FY25,
Okay.
what jumps out at you?
Well, the revenue from operations in India reached 563.2 crore.
Okay.
Which is an 18.3% increase compared to the same period last year.
That's pretty good.
Yeah, it's a healthy growth rate.
Especially considering they're expanding their manufacturing.
Right, exactly.
In India.
Yeah, and their investor presentation actually highlights this growth. It comes from both existing and new customers.
Oh, interesting.
Which means they're not only retaining their current clientele, but also expanding their market reach.
It seems like those investments are starting to pay off.
Yeah, for sure.
That's a really good sign for their long-term sustainability.
Absolutely.
Having a diverse customer base, I think, really helps spread the risks.
Right.
Makes them less vulnerable to changes in any single market segment.
For sure.
Now, when we look at their standalone adjusted EBITDA,
okay,
what's the story there?
So it was 17.5 crore for the first half of FY25.
Okay.
With a margin of 3.1%.
Okay, so that's a lot lower than their consolidated margins,
right,
which were around 8.8%, if I remember correctly.
Yeah, 8.8%, you're right.
Why such a big difference?
Good question. And luckily, their investor presentation gives us a little insight into this.
Okay.
They point to a few factors that are putting pressure on their standalone margins in India.
Okay.
Specifically, lower gross margins on new styles and customers, and higher manufacturing costs during the first half of the year.
So it seems like the ramp-up of their new factories in Chennai and Gurgaon is having an impact here as well.
Yeah, I think so.
Makes sense.
New facilities often take some time to reach optimal efficiency levels.
Sure.
Plus, they're introducing new styles and working with new customers, which can initially lead to lower margins until those relationships mature and production processes are fine-tuned.
It's understandable that there would be some growing pains as they kind of integrate these new facilities and expand their operations.
It's a short-term trade-off for long-term gains.
And despite these challenges, their standalone EBIT margin, which stands at 7.2% for H1 FY25, paints a more positive picture.
Yeah, it does.
Okay, remind me what EBIT is again.
Yeah, so EBIT stands for earnings before interest and taxes.
Okay.
And it's a measure of a company's profitability that excludes interest and tax expenses. This gives us a clearer picture of their operating performance.
Okay.
And the key difference between EBIT and EBITDA is that EBIT includes depreciation and amortization expenses, while EBITDA excludes them.
Okay, so a healthy EBIT margin suggests that their core operations in India are fundamentally sound.
Yeah.
Even though things like depreciation related to their new factories are currently impacting their overall profitability.
That's exactly right.
All right, now let's shift to their standalone balance sheet. What does that tell us?
So as of September 2024, their total assets grew to 1,012.4 crore.
Okay.
This growth is mainly attributed to their investments in property, plant, and equipment, right-of-use assets, and inventories.
Okay, so reflecting their commitment to expanding their presence in India.
Exactly.
How about their liabilities?
So their standalone equity increased to 558.7 crore.
Okay.
From 374.1 crore in March 2024.
Okay.
This significant increase in equity further strengthens their financial foundation in India.
Okay.
And demonstrates their commitment to building a strong balance sheet.
That's good to hear.
Yeah.
It means they're not overly reliant on debt financing.
Right.
And are growing their equity base.
Right.
Which is a sign of a healthy and sustainable business.
Yeah, absolutely.
Okay, last but not least, let's look at their standalone cash flow statement.
All right.
What insights can we gather from that?
Their net cash flow from operating activities for the first half of FY25 stood at a healthy euro 19.8 crore.
Okay.
This indicates that their core operations in India are generating positive cash flow, which is crucial for their ability to reinvest in growth and meet their financial obligations.
However, we also see a substantial outflow of 173.3 crore from investing activities.
Correct.
Primarily for property, plant, and equipment for their new factories.
Right. Exactly.
Showing that they're putting their money where their mouth is when it comes to expansion.
Yeah. They're not just talking about expansion, they're backing it up with concrete investments.
Absolutely. And on the financing side, We see a net inflow of 135.4 crore, largely from the issuance of share capital, which we discussed earlier, as part of their broader capital raising strategy, to fund this expansion without taking on too much debt.
So to sum up, Pearl Global's standalone performance in India really echoes their strong consolidated performance.
Yeah.
They are strategically investing in growth, managing their finances prudently, and navigating the challenges of expansion effectively.
Well, this has been a really fascinating look at Pearl Global.
Yeah.
I think they're firing on all cylinders right now.
Absolutely.
Their record-breaking results, strategic investments, and prudent financial management, I think all point to a bright future.
I agree. They're demonstrating both ambition and discipline.
Yeah.
A combination that's essential for sustainable growth in any industry.
And I think their commitment to diversification geographically and in terms of their customer base really positions them well to weather market fluctuations and seize new opportunities.
It does.
And one last thing I wanted to touch on is their commitment to consistent dividend payouts.
Yeah.
I think that sends a strong signal to investors.
Absolutely.
That they're sharing the fruits of their success.
Right.
And are confident in their ability to continue delivering strong returns.
It's a compelling story of growth and resilience.
It is.
But as with any investment, it's important for your listeners to conduct their own thorough research.
Absolutely.
And consider all the factors before making any decisions.
We've provided a framework here for understanding Pearl Global's performance.
Right.
But it's essential for investors to do their own due diligence.
Yes.
Draw their own conclusions.
Informed decision-making is always the best approach.
Well, on that note, I think we've covered everything we set out to in this deep dive.
I think so.
It's been a really fascinating journey.
Yeah, it has.
Through Pearl Global's financial landscape.
I agree. It's been a pleasure unraveling the story behind the numbers.
Yeah.
And gaining a deeper understanding of this really dynamic company.
And as always, we encourage our listeners to stay curious and keep diving deep into the topics that matter to them.
Until next time.